have a lot of time for the next session, but it's a really important one. The two most embarrassing numbers about India are 47%. We only have 47% of kids left in government schools. That's the most embarrassing number about India. And the next most embarrassing number of India is our credit to GDP ratio is only 47%. We have managed to keep it at that number for decades. And obviously the nationalized banks, except SBI, are holy cows. And in India, we don't kill our holy cows, we starve them to death. But this paper is sort of an important way to sort of deal with it without starving it to death. I think the direct costs are obvious, at least from my perspective. The Ministry of Skills budget is 8,000 crores. We put 4 lakh crores into nationalized banks, and the risk-weighted assets are lower than what they were 5 years ago. The opportunity costs are obviously substantially captured by the credit to GDP ratio. On 29 July 1969, the Prime Minister told the Lok Sabha, I am nationalizing banks to give money to the small entrepreneurs, to self-employed, and to farmers. Untino ko to mila nahi, but Bhushan Steels had more loans than India's central government allocation to primary education. But I think the question is, I know many people will ask why, but I think the most important part of this paper is sort of how and how far. So we'll have 30 minutes for the paper, 15 minutes for the two discussants to sort of, we have a lot of time. It's a very important discussion, so let's kick it off with half an hour.
Thank you. So Professor Arvind Panagariya and I will be presenting tomorrow together. I'll take half the time, and he'll come in the latter half when the more important issue of how and how far would be discussed. So Manish mentioned these two numbers, 47%, and I think they're related. They're related through where the public money is being spent, quite a bit of which is on public sector banks. In the first session today, we also heard about lack of public funding for research. Again, then we have to ask, where is it that the money is being spent? Some of it is going to keep the public sector banks alive. Whether they're thriving or not is another issue. So privatization of public sector banks, as always, I would claim that I actually started this work with Professor Arvind Panagariya with an open mind. And the process that unfolded, or the facts that unfolded over a period of 3 months, were quite interesting. And which helped us converge to the title of the paper, that why is not even being questioned, and it's about how and how far. And while writing this paper, actually we consulted many people in the government, outside the government, in the private sector, and it seems that though we may not be aware of it, but there's a lot of understanding at various levels that the question of why is more or less settled. But to the extent that we may still be somewhat uncertain about an emotive issue such as this one, let me walk you through some data. So the main issue being discussed is credit to GDP ratio in India has been low and stagnant, at least for the past 12 years. Asset quality has been poor, or which means that non-performing loans have been high and operational efficiency low. So when we look at the performance of banking sector, more or less we look at growth, asset quality, and operation efficiency. And we are claiming that it has been low compared to the international standards, and that it has declined in the last 10 to 12 years. So if we want to correlate the performance of the Indian banking sector with ownership, that correlation is very, very stark. And we do it in a number of different ways, which is something that I'll present upon. Now, one may ask that why talk about privatization when there can be a toolbox of policies, and some of which has been tried. Consolidation, make them larger, they'll start performing better, have tighter regulations on them through something like prompt corrective action, recapitalize them, that they are not able to perform well because they're starved of funding, we look at each one of them. And in fact, all of these policy actions have been taken quite rigorously in the last 5 to 6 years, and plus more. But the fact of the matter is that there is a great reallocation happening within the Indian banking sector. Now, not just the borrowers, but depositors have started to shift in great numbers to private sector banks. We have been hearing all along that public sector banks have not just an explicit deposit guarantee, but also an implicit one, and therefore depositors generally have stayed with them. But as I'll show some of the data, the new lending and deposit collection that's happening through public sector banks has really shrunk to trivial numbers. Then the question is, so our takeaway is that why is very, very easy to establish. The challenging part is how to do it, and this is what we are proposing in this paper. So now some data to put flesh on what I just described. Credit to GDP ratio has been small and stagnant in India, compared to a world average of nearly 100% of GDP in 2020. India's bank credit to GDP ratio was a little above 50 in 2020, and it has shrunk in the last 10 years by 2 percentage points here, as compared to many other countries where it has grown. Asset quality has been relatively poor in India, but during the last 1 decade, it has increased by quite a large amount. As is the case for efficiency indicators, there are a number of indicators one can use. I'm just presenting the data on return on assets. Was low to begin with in 2010 for India, and has declined even further, both in an absolute sense and in a relative sense, relative to other countries. So that was just to establish the case in a cross-country sense, that India's banking sector has been underperforming, and this underperformance has increased during the last decade. In the paper in which we looked at a whole host of data at the bank level, at bank group level, in a cross-sectional sense, just looking at ownership as a differentiator, and in a time series sense, there are some other developments that we notice while looking at the data, which may be of interest, that when we look at the last 30 years post-liberalization, there are some distinct patterns we see as far as the banking sector growth and health is concerned. So 1990s was a year of status quo. There was very modest growth in the sector, and the sector had high NPAs. 2000s was an interesting decade where things improved quite a bit, actually across ownership. There was very high growth of banking sector in all different metrics, advances, deposits, assets, you name it. And there was improved outlook on NPLs and efficiency as well. It's the last 12 years since 2010 that there has been a very sharp and distinct slump in growth as well as other parameters of health and efficiency. So this is what I just described. Deposits as percentage of GDP increased quite dramatically during the decade of 2000s, increasing from about 50% to 74% of GDP. That's a very rapid increase, unseen in India, and also somewhat exceptional perhaps in a cross-country sense. Assets as percentage of GDP to increased from 60% in 2000-2001 to nearly 95% a decade later. But the point of the matter is here that this growth could not be sustained. There has been stagnancy in the decade that followed. And this we can see even more starkly in credit as percentage of GDP, which is a very strong correlate or determinant of economic growth. And during this period, actually non-performing loans as percentage of GDP have increased from 1.3% in 2010 to 4.2% in 2020-21. So when we talk about these numbers, compare it with R&D expenditure, public expenditure as percentage of GDP, expenditure on education, etc., and you can pick the variable that you are interested in. This great reallocation that I talked about is seen here in this table. So when we started writing the paper and we were still thinking about what is the tagline or what is the approach we want to take, early on we decided to actually differentiate between the SBI, the largest public sector bank, and other public sector banks to see whether that will make our narrative richer. And interestingly, actually, SBI, which accounts for nearly a quarter of banking sector assets, looks a bit more like an average private bank than any other public sector bank. So in order to make our narrative, as I said, richer, we have separated out SBI from the other public sector banks, 11 of them currently. So as a part of this reallocation, the share of SBI has been more or less steady in the last decade at about 0.25% of the total banking assets or credit. The reallocation has happened from all other public sector banks to private banks. So compared to 20% of the total in bank assets in 2010, private sector banks now account for 33% of total assets. They account now, instead of 20% of total credit in 2010, now they account for almost twice as much, 38% of bank credit. And equally remarkable is the reallocation of deposits to private banks. Instead of 18% in 2010, now they account for nearly a third of bank deposits. Now, this reallocation or this transition from all other public sector banks to private banks is even more starking when we look at incremental changes rather than just stocks. And here we look at more variables. One complaint one often hears about is that private sector banks or other enterprises do not, let's say, generate jobs. They are not interested in branch expansion. What will happen to priority sector lending when private sector banks increase their presence in the sector? Who will investment in government securities? So we look at many more variables. And equally striking results, if not more here, that of the total new deposits that got generated during 2014-15 to 2020-21, almost half of them were generated by the private banks. As compared to that, other public sector banks only could attract 15% of incremental deposits during this period. More striking is their contribution to loans to the private sector. 70% of new credit generated during this period was given by private banks. Credit to private sector, new credit to private sector during this period was flat for other public sector banks. SBI has been a steady quarter. Nearly a quarter of the contribution is being made by the SBI. And now, because private sector banks were generating more business in general, they could also invest more in government securities. So 40% of the new investment in government securities came from private banks. And similarly, more than half of priority sector advances were made by private sector banks. And they are mandated under the law to do this. So it's not that they're shirking their responsibilities. There's no way to do that. But just compare these with numbers from other public sector banks. Now, I think if I have to take away one thing from this presentation, I personally found this chart on new employment generated to be the most telling. Nearly 250,000 new jobs were created by private banks during this 6-year period, as compared to contraction of 23,000 jobs in other public banks and 37,000 in SBI. So, of course, private banks are the employment generator during this period. And they are the ones who added to bank branches when others were either flat or contracting. Similarly, which banks have faced more frauds? There's no comparison whether we look at in absolute amounts or whether we look at as percentage of assets. And I think just 3 last slides for me before Professor Panagariya takes over. Here we are looking at bank level data, annual bank level data over 5-year periods. It was easy for us to collate the data from 2005 until 2021, so we just divided them into equal 5-year periods. So during the decade when performance overall was very strong all around, other public sector banks are more or less at par with private banks. So private banks are not included, so their averages are captured by the constant, and others are differential from the average of private banks. In 2010-11 to 14-15, they start to underperform. Their credit growth is nearly 6 percentage points lower than that of private banks. Deposit growth is slower by about the same amount. Credit to deposit ratio is lower by 3 percentage points, and so on and so forth. In the last 5 years, this performance gap has widened quite a bit. And this is when we are seeing this reallocation happening. Other public sector banks, credit growth is 10 percentage points lower than that of private banks. Deposit growth about 8 percentage points lower. Credit to deposit ratio 13 percentage points. And of course, they continue to over-invest in government securities, that being a very safe investment for them. NPAs 7.5% higher. And return on asset and return on equity are similarly much smaller than that of private banks. Professor Panagariya, all yours.
Thank you, Poonam. Not sure why we switched. You're doing such a wonderful job. Could have completed it. Okay, all right. So very quickly, these following slides I want to race through rather quickly. These were the kind of actions taken by the government, and what the next set of slides are going to try to show is that that has not made a big impact in terms of improving the performance. So this is prompt corrective action, and you can see, so the first 2 bars really are showing the performance of the banks which were subject to prompt corrective action, and then the other bars are labeled, you got other PSBs, SPI, and the private banks. And you can see that, not a big difference, not a big difference. Rate of return on assets, rate of return on equity, once again, not a big difference by prompt corrective action. Gross NPLs, comparatively or otherwise, you won't see a whole lot of reason. In fact, for the post-PCA, gross NPLs are actually larger than pre-PCA. So this was an ongoing process of the NPAs kind of accumulating, and that continued in that direction. So, all right. This, I think, is a rather telling graph. This is market capitalization of PSBs other than SBI. So the 3 sets, SBI, the other public sector banks, the 11, and the private sector banks. The red one is the private sector. You can guess very easily. While SBI has shown some improvement in market capitalization, the remaining 11 taken as an aggregate, almost no movement. Maybe a slight upward movement, but not really. I mean, after recapitalization, you see a little bit, but that's about it. Market cap of PSBs is like behind the market. Yeah, so this gives a comparison. Just if you want to see how the shares are doing really, how the market valuation is doing related to any of the indicators, even the GDP deflator, which really doesn't move so rapidly. Even relative to the GDP deflator, actually, the valuations of the other public sector banks are doing poorly. I mean, so the dotted red line, that's the other public sector banks, their market evaluation. And then the other three indicators we have provided here. But you can see even the black dotted line with longer lines and a dot following is moving faster over time than the market valuation of the 11 public sector banks. So really, I think these 11 banks are not doing very well. This again is at least somewhat dramatic, and look at the set of bars to the right of this slide. You'll see that the black one is showing the valuation, combined valuation of the 11 public sector banks, and the red one is showing the amount invested in recapitalizing these banks. And so $43 billion was invested in recapitalizing these banks over the last 10 years. And the market evaluation is about 2/3 of the recapitalization itself. It may still rise up and all, but so far it still falls short. Okay, so now, to summarize, why privatize? I think a lot of it has to do with the performance, about which what Poonam presented and what I've just shown you has provided the details. There are some issues of stability of the banking sector. Some earlier literature where there was that episode in 2008 after the global financial crisis. At that time, it had happened that depositors have moved towards the State Bank of India, and ICICI Bank had some problems. There's some literature on that, I think, and that literature ultimately concludes that in the end, it was the implicit guarantee that depositors saw that the public sector banks had and the private sector may not have had, which led to this particular episode. But after that, of course, from the numbers that Poonam has already shown you, you've seen that depositors have clearly changed their mind now, and they are going lock, stock, and barrel towards the private banks. Private banks are providing better returns, and they provide better service. This I say not just from looking at any of the data, but also talking to all my relatives and friends here who are all gravitating towards the private sector banks now with their deposits. Now, a case is often made that public sector banks have social objectives, private sector banks don't, and therefore we do need the private sector banks. First of all, I'm sure you need 12 banks for that, but also I think more importantly, one has to do a cost-benefit analysis. For everything, one has to ask the question that, well, I'm doing this, what is my alternative to do this, and what are the costs between what I am doing and what the alternatives are. A lot of the social objectives can be pursued, should be pursued actually across the board using both private and public sector banks. And indeed, some of it is done. So for instance, priority sector lending, private sector banks are as much subject to that. And they do their bit very effectively. There is no question about that. Many of the other things also, like on Jan Dhan bank accounts, I think in the reliance was greater on the public sector banks, but there is no reason why should that be. If that is a social objective, private sector banks should be equally asked to pitch in. A lot of the social objectives can be pursued through the instrumentality of private sector banks as well. Let the RBI use the regulation to do that. Now, large number of governance issues, lots of details which is spelled out in the paper, but very briefly, I think there are few important things which I would mention. One of the issues here is that the salary structure is government determined in the public sector banks, and the way it is that At the top level, it holds the salaries way down. So if you look at even the salary of the State Bank of India's CEO and managing director, he is paid less than the smallest private sector bank for which we could find a salary. And of course, if you look at the HDFC, if you compare the SBI CEO salary to that of the HDFC, there's, I think, a factor of something like 15 or 20. I mean, the salary differential at the top is really large. On the other hand, you go down below, the salaries are significantly higher. If you look at the employees at the lower level, then the public sector bank salaries typically are significantly higher. Now that creates the problem, that in terms of any innovations, etc., skill, the kind of skill set that you require and all, there being much greater inflexibility in this public sector banks. A lot of the required skills actually are not there, whereas the private sector banks have that, and the salary structure conforms more to productivity. So that is one very big difference. But then there are other governance issues very quickly. One big one is the vigilance that the public sector banks, being essentially subject to all sorts of government rules, they are also subject to the vigilance by the 3 or 4 different, at least 3 vigilance bodies, which obviously forces the leadership at these banks to act extremely conservatively, because what happens is that one small mistake can bring in huge punishment, but even a very big kind of win on the performance side will not bring huge rewards. So naturally then the behavior is very conservative. Keep doing what your predecessor did, rather than be innovative, because if you do what the predecessor did, your risks are minimal. Political interference is another issue. How when elections happened, certain lending activities go in a certain way and so forth. So there is that. And then there are regulatory issues. What has happened is that public sector banks are regulated not just by the central bank, but a lot of the regulation of the public sector banks is done by the government, which is the owner of these banks. So they are, these banks, public sector banks, are created, so they are really statutory the statutory bodies really created by the legislation. They are not bodies created under the Companies Act, which is the case with the private sector banks. So they're governed very differently, and so there's a dual regulation on these banks, but from the RBI side also, therefore, it becomes dual regulation. There's one set of regulations that it applies to private sector banks, another set of regulations that it applies to the public sector banks. So it really is, it creates very uneven ground ultimately. I did something crazy. All right, let's see. Okay, so that I think really is largely governance issues. One last point very quickly before I get to how and how far. One may ask the question, can we not do the reforms within the public sector banks without the change of ownership? And there have been several committees which have made recommendations, including the last one, which was in 2014, a very well-known report by the Naik committee. In principle, I have no issues with that, actually, or we have no issues with that. If we could actually do that, that would, I think, solve the problem more or less in the way privatization would. But we are just very skeptical that this will happen. I think the bureaucratic system in India is such that that kind of reform within the public sector ownership is just not going to happen. And well, the last history of last 8 years now bears witness to that fact that you have 8 years since that committee report was submitted. There was general consensus that this was a good report, but nothing has happened. So I think we really therefore lean in favor of privatization. The case we make is that SBI leave that aside for now and privatize all the remaining 11 banks. It's not a principled choice, meaning if principle is applied, if principle applies to one, then why not to the other? Why not SBI included as well? I think today the political salience is not going to be there. We are very far from getting to the point where SBI is also privatized. So we've just chosen that. Look, go for at least these 11. That itself will take 5 to 6 years, and then you can come back, reassess in some years. All right. Which banks first? Now that two schools there. One is you could take the just as we want to spend the most crumpled notes from our wallet first and keep the best one in our wallet for the last. That's one approach. The other one is to go in with the best ones first. The general tendency, of course, is to go for the weakest ones first. We take the view that, look, start with the stronger ones because ultimately this is a complicated, contentious issue politically, and you want to make a success of the first one or two banks that you privatize, both in terms of being able to successfully actually privatize. You want the buyers to come forward. You don't want it to linger on, and you do auction after auction and no buyers come forward. So that's one reason, but also the other reason is that you want to see the bank, once it goes in private hands, to start taking off rather quickly. So for both of those reasons, we lean in favor of going with the strongest ones within this basket of 11 banks first. And based on various parameters which are listed here, we sort of identified ultimately Bank of Baroda and India Bank as the two first. Canara Bank is another possibility, but I think that sort of, at least in our ranking, comes third. So that is our, in terms of the choice of the banks. That table gives you a lot of the information on each of these 11 or 12 actually public sector banks, from on which we based the choice that I have already indicated. You'll see that if you look at the columns that are third and fourth from the right side. So go from all the right to left, and third and fourth, they give you the rates of returns. And you'll see that, except for India Bank and for the Bank of Baroda, the returns actually are negative for, and of course State Bank of India, which is not part of the privatization basket we are suggesting. The returns are negative actually for all the remaining 9 banks. Okay, so all right, what is required? What will the privatization process have to look like? Well, first of all, there has to be full withdrawal of the government from regulation, governance, and management. If you try to do a halfway house, buyers are not going to come forward, is our judgment. And in any case, I think for the purpose of ultimately giving them proper private status, that is a desirable thing to do. So full withdrawal will be required. How this will be done, I'll come to that. All powers to regulate the private banks should pass on to RBI. Then a private board with no more than 1 or 2 government-appointed directors on it should be solely responsible for the governance of the privatized bank, and that board will then appoint the management and the salaries, etc., of all the staff, including at the top end, and the rest ought to rest with the board. Banks to be incorporated under the so for that you'll have to incorporate first of all. Well, I'll come to the process. I think the next slide. So all right, let's just go to this. So the government will first need to amend the legislations that nationalized the banks. You remember I mentioned there's two legislations, one in 1970, another in 1980, which had nationalized these banks. And from that legislation flows both the legal status of the banks, which are basically, so therefore they're statutory institutions, and from the legislation also flows their banking license. So banking license under which they operate is not one issued by the RBI, but it flows from the legislation itself. So you'll have to first amend that legislation. It is actually an amendment along the lines indicated here, is currently, it has been, I think, blessed by the cabinet, but according to reports, it will be in the next monsoon session, it will be put into the parliament. So there's some progress underway already on this. Now, once that legislation is passed, then the banks can be incorporated under the Companies Act. That will be a big deal. And then the license also ought to be shifted to the RBI. So that also has to be part of the first step towards privatization. In the next step, the government will have to dilute its stake below 50%, thereby paving the way for the appointment of a private board. Now, here there are two broad options how to do it, meaning how to bring this stake below 50%. One option is to dilute the stake through sales to a diversified base of shareholders. So, you just sell off the stocks to the buyers who come forward and keep doing it until the stake is reduced below 50%. The other one is to find a strategic buyer, somebody big one. Certainly that has been done very recently in some of the, at least some experience there. Axis Bank actually had started as a public sector bank, really. 100% of the ownership of Axis Bank was there, but it was incorporated under Companies Act and operated under the RBI license. And then gradually the government had diluted its stake in there. But in the Articles of Association of this Axis Bank is also written that, you can have only one government appointed member of the board and one LIC, the Life Insurance Company appointed board, which also had some stake in the Axis Bank. So it's a similar kind of thing that one could do here. The government will also commit. So if you go through this diversified set of buyers, then the government will commit itself to a 6 months or shorter window during which it undertakes this investment as per a pre-announced schedule. So for instance, Bank of Baroda, the stake of the government is 64%. LIC has another 5% stake. So I suspect, now this is, I'm not 100% sure, but I suspect this will require, therefore, at least 19% plus or 20% plus disinvestment by the government to bring the stake, public sector stake, down below 50%. So if it does 4% every month, and it could commit to do it on the 15th of every month, then in 5 months it will be able to go below 50%, allowing the private board to be appointed. If it is done in this pre-announced manner, our hunch is that the share prices will begin to move up, and eventually they'll get to the where the share price ought to be at the post-privatization level. So part of the benefit of the rising share prices, the government ought to be able to internalize once it has done one sale or two sales. When the markets begin to see that yes, the government is determined that it's going to do that. All right, that is the diversified. Alternatively, sales to a strategic buyer. Then in many public sector banks, the government holds more than 80% stake. And in these cases, it can look for a substantial strategic buyer who may buy the entire stake sufficient to bring the government stake below 50%. That buyer would value the shares obviously according to her expected valuation of the bank post-privatization, naturally. So that auction will effectively get the government the full post-privatization value or near full post-privatization value of the stocks. The rest it can keep, and then gradually decide whichever way it wants to disinvest the remaining stake, meaning below 50%. In both the cases. So the buyer in this case, the strategic buyer will play the role of the traditional promoter and play a key role in the appointment of the directors as per the RBI and company law rules. Once again, the government representation on the board should be limited at the most to 2 if it has a large stake. But also with the provision that if the stake drops below 25%, then the number of directors should drop to 1 as well. So that's a suggested one. I think one can do variations on that. That is not an issue. 2 minutes. Okay. So very quickly, I'll go. Other issues: should we consolidate before we privatize? We choose to say no. Who should be allowed to buy the banks? I think this is a bigger issue. And one. Here you see, 2 sets of claims. One, say, oh, there are no buyers. So then, well, allow the corporations, which may be non-financial, including the non-financial corporations, but no, we don't want them. But then that means that stay with the status quo, right? So we opt against that. I think status quo is certainly a worse choice than allowing the non-financial corporations to come in and be able to bid. And we discussed that in greater detail. We basically argue that, look, even if you look at the existing experience, there are several non-financial corporations which own non-bank finance companies and BFCs, which are deposit taking. And if you look at the history, there has been no cases, no visible cases of wrongdoing by these NBFCs. If anything, Island FS, which really brought the entire crisis in the NBFC sector, was the one which was not owned by a non-financial corporation. You got Bajaj NBFC, you got Mahindra NBFC, and their record has been good. And you can imagine why that would be the case, that a very large group whose valuation in the market is 20 times of what the bank itself would be valued, is not going to risk its reputation by doing something that they should not be doing if they were to invest in banks. And of course, the RBI can place regulations that, look, you cannot lend to your own affiliates. So we actually make the pitch that you got to allow the non-financial corporations to come into this. Okay. Well, implications of the status quo, I've sort of described them, so I'll leave it. Conclusion: privatize now.
So I'll now ask Ashwini to give us his thoughts.
Good afternoon, and thank you, Dr. Gupta, for inviting me. I'm glad that I brought some of the wet weather from Mumbai to here. We have too much of it there, and we need some more here. At the same time, the atmosphere in this room with the paper just presented is decidedly gloomy at this point of time for public sector banks. And Manish has already said SBI is a holy cow. So though Dr. Panagariya exempted SBI, yet it's not exempted in that sense. So I'm not going to defend public sector banks per se. There are performance benchmarks where it is shown that in this paper and otherwise also, that there are gaps in performance in terms of not only the matrices by which banks are normally measured in terms of return on equity or return of assets, etc. I have 2 or 3 broader themes to talk about. One is, of course, this entire the way banks have been allowed to function in India in an independent manner is relatively recent, post 91. So which means we are looking at a history of about maybe 30 years, 32 years as of now. Before that, and I joined the bank in 91, so therefore when I joined, we used to get circulars from the regulator which specified the interest rates to be paid on all deposits, different levels of deposits, and interest rates to be charged on each loan, how much to invest, how much to. So it was completely controlled, and that was the policy then. So I don't want to argue on the right whether it was right or wrong, but it was the policy then. So therefore, since that time and coming to now, the 94-95 liberalization, whereby about 3 to 4 private sector banks were brought in, given licenses, and they were floated largely by professionals. So this is the key differential one has to acknowledge, that it's not that before 91 there were no private banks. There were a lot of private banks of smaller sizes, community-based banks. You have various names like Catholic Syrian Bank or Tamil Nadu Bank and various other banks, Lakshmi Vilas Bank. And these banks, some of them were doing well, some of them were not doing well, but these were very heavily influenced by the families, promoters, which were running those banks, even though supposedly they were having good corporate governance. And we have seen some of those banks run into problems in the recent past. So therefore, the success of private sector banking in India is actually attributable to about 4 or 5 large banks. These are run largely by professionals. Of course, there is one promoter-led bank. There were rather two, out of which one has actually not done well and has needed support in the recent time. One which has been doing well, and we'll have to see how the second generation pans out in terms of handing over to a professional management. We'll have to see that. So therefore, if we can create more of these professionally run banks, yes, surely that's a very, very good thing. Having said that, if you look at the record of universal banking licenses issued in the last 10-15 years, they're just two issued. One, of course, was an MFI conversion, the Bandhan Bank, which is again finding its feet, but it had a very strong base of low-cost deposits and a very large number of depositors and also borrowers, small value borrowers. So therefore, a very different business model. And the other bank, we know that again is trying to do well, but the others are still somewhere on different levels. As far as the recent performance is concerned, which is this 2010 onwards, 2020 period or 21 period, which has been particularly bad for public sector banks, because as was shown in the paper, from 2000s, in the 2000s, generally the performance of public sector and private sector banks was equivalent. The differentiation which was there was that the public sector banks were focused on infrastructure financing, a lot of the power plants, roads, and various other infrastructure projects, because the DFIs had gone out by that time. And therefore, the requirement of funding these, and the interesting point is these were largely private projects. They were not government projects largely. So therefore, private projects were being funded by public sector banks largely in these 2004 onwards, and which ultimately didn't do well for various reasons. Let's not go into those reasons as to what those reasons were. And that hangover from the period of 2005-06 onwards till about 2011-12, when the infrastructure financing reached its peak and then tapered off suddenly, because the banks had a lot of loans which were not paying back, and there was a recognition problem for some time. Ultimately, the RBI decided to actually force the banks to recognize everything. All the restructuring schemes which were tried didn't work. And therefore, the banks were suddenly, by 2015-16, when the first asset quality review came in, the public sector banks suddenly had a very large amount of NPLs. And then we know the huge amounts of capital which was given in the last 5 years, 2016 to 2019 perhaps, those 4 or 5 years, which has been captured here in this paper. And now, of course, that hangover has been taken out. Most of those loans have either been resolved or written off or absorbed or resolved through Bankruptcy Act as well. So therefore, this problem of the NPLs and all, it used to be there in the 90s. I was part of that health code system which Dr. Panagariya's paper talks about. Very interestingly, we had large sheets where we used to write down all the by hand. So I've seen that part, and of course there was no concept of an NPL then. So therefore, initial whatever was recognized was a generic industry-wide issue. It wasn't restricted to public sector. In any case, public sector was 90% of the whole system. So therefore, this problem of NPLs is a relatively recent issue. And then, of course, the result of that large overhang of NPLs was the so-called twin deficit or twin balance sheet problem, whereby on one side you had large NPLs and therefore you needed to provide for it, and all the capital which was invested by the government actually went towards providing for those NPLs, because there was a regulatory norm about capital adequacy and provision and etc. And therefore, the banks, public sector banks, could not invest in fresh loans. You have to remember in the 2000s, when these banks were giving loans to agriculture and industry, which is captured in the paper, the private banks were giving loans to retail, which is to housing loans, mortgages, car loans, personal loans, so all retail. They didn't take this risk of investing in industry and SMEs and agriculture and even infrastructure. Now, one can argue that it was a choice of not making good choices in terms of asset allocation, and there was some force of the government towards it. I think there's a mix of everything, which means there definitely was some direction that the agriculture and SME has to be supported. This has been a stated policy. And infrastructure, again, there were opportunities. Maybe there was some exuberance in the public sector banks in doing that once some of the private entrepreneurs were showcasing good amount of projects like this. But the private sector banks stayed away. But did they stay away because of a risk perception which they had, a better risk management which they had? Was it the case? I think that has to be analyzed in more detail. Or was it the case that they had opportunities in the retail side and just continued to invest more and more there? Over time, of course, most banks, private and public sector, are doing more of retail. So therefore, what that tells us is that perhaps the capacity of the economy to absorb this kind of credit, again in different segments, had to be better in different times. And this I talk about, for example, in MSMEs. This is a very, very controversial topic where a lot of numbers are flown about in terms of 20 lakh crores of requirement and about 2 to 3 lakh crores being met by formal banking sector. That's a number talked about. But the point is, as bankers, when we look at whether as a private sector or as a public sector, when we look about the MSME funding, we find that this ecosystem is not uniform. There's a large 70-80% of MSMEs which are very subscale for various reasons. And I think Manish has a lot of information on why they are subscale. But those are subscale below, let's say, 10 lakhs, below 5 lakhs. And those are funded and they go under very, very quickly. Because of one jolt, they will go under. Because most of them are either suppliers to some medium-sized or large unit, or they are doing some kind of a job work in between. So therefore, it's tough for the MSME sector as a whole unless there is an overall support in the system. And banking is just one part of it. Agriculture, again, we have seen this agriculture, the way it has evolved. And now we have, of course, very, very good ideas in agriculture, whereby we see the high-tech kind of agriculture coming in, and we see the better varieties coming in, more private sector is involved, so which is a good sign overall. And what we have realized is that even as private sector, public sector banks, we can't really open branches everywhere. So therefore, this entire business of using banking correspondent models, using co-lending mechanisms through NBFCs, I think the ecosystem has to move as a collaboration between different players. It is not either or. So it's easy, I mean, if we privatize tomorrow all the 11 or including SBI, all the 12 banks, what are the implications then? So we have seen that while jobs are being created in the last 10 years at least by private sector banks, and the retirements are happening in public sector and not enough recruitments are happening. Is it the case that the employment to start with was higher, much higher, and therefore they are trying to reduce it to some extent, and thereby, is that the case? Or the incremental employment only has to be seen? Similarly, same with branch openings, because branch openings involve cost. And if you look at the total number of branches in the country, how much is the share between public sector and the private sector? I think we will see that there is a need for private sector to grow branches more. And they've realized digital alone is not going to be enough. What probably has to be analyzed further is this entire piece about the technology which has come in through fintechs and big techs, and that is playing a big role in financial inclusion alongside other elements which are there. So I think that also has to be considered as part of this entire banking debate which is being considered. And government is on record to say that 2 banks will be privatized. So therefore, there is no debate on that part. Which of the 2, we can always argue about the first, the best, or the medium, or the worst. We can argue about that. Clearly, there are 2-3 banks in those public sector banks remaining, which are smaller, very small in size, and perhaps they need to be either consolidated or privatized. So we'll see what those banks are. And we should look at the experience of these 2 banks. Because clearly, if all the banks are privatized, let's say, on a hypothetical basis, then what are the implications? some of the implications have been talked about, and there are both sides. The crisis management is clearly one. So tomorrow, if there had been no SBI, no other private bank, no other public sector bank, the support which was given in 2020 to one of the leading fourth largest private bank, how would that happen? The others, we have to remember that the contribution by SBI to that rescue was 40%. And the rest of all the private banks which were brought in was 10% or lower. And half of them sold off within 1 year. SBI still stays invested because it is mandated to do so. So therefore, crisis management clearly is one area where the government would want some banks. SBI may be enough or may not be enough. The other is, of course, the part about the Jan Dhan, which Dr. Panagariya very candidly said, that the more responsibility should have been given to private banks. It was given, but they didn't take it up. So the point is that how do you make private banks to take up that kind of responsibility? If there are no private public sector banks, how will Jan Dhan be opened? How will micro insurance, which is the current focus in the Pradhan Mantri Jeevan Jyoti Bima, which is the life insurance scheme, and the other is the accident insurance scheme, etc. How will they get taken up? The saturation levels are still about 4-5%. Atal Pension Yojana. So much as we like it, we don't like it. India is at a stage of development where it needs state support, and that state support needs vehicles. So I'm not saying private banks cannot be the vehicle, but the history of the past 20 years shows that the vehicles have perhaps not enthusiastic enough to take that up. So my response to this overall response is that while SBI has done well, and SBI has created world-class companies in the private sector, in mutual funds, in life insurance, general insurance, where the model is the companies in the private sector, all the staff is from the private side, the CEO, CRO, perhaps a couple of others are from the bank. So therefore, this model has worked well for us, and this shows that even as a public sector bank, given the independence which we have got, we can create world-class institutions. And therefore, my argument to privatize now would be, why don't we create more SBIs? Maybe not 25%, maybe 10-15%, but there is a scope to create that. So that's why I rest my case. Thank you very much.
Thanks, Ashwin. Richard? Not really, but your funeral, I can't guarantee it.
I just want to make sure. So one thing you should know before I start is I was asked to do this last night, so I put together some slides this morning, but I'm going to draw on people in the crowd to help me do this discussion a little bit. So first of all, who am I? So since my name does not appear on the schedule, so I'm an economist. I have two souls. I'm an economist who studies macrofinance, but I've also spent about a decade doing these hardcore plumbing exercises of financial sector reform, working at the IMF. Now, I see some of my former colleagues from the IMF. I should be very clear to say, given especially how sensitive the topic is, I'm not going to be, this is definitely not an institutional view. This is very much a personal view. All right. So the paper also has these two souls in a way, that like my two souls. I think that's why Dr. Gupta and Professor Panagariya asked me to be the discussant. The first part of the paper is really about to educate, instruct, and explain kind of the intellectual basis for privatization. And the second part of the paper is really giving us a roadmap for, which is also founded in a strong intellectual basis for why to privatize. Now, I would say what I'm going to be saying is the conclusion from the first part is strong and correct, but the reasons presented in the first part are exactly the opposite. So I'm going to be making that case first. And second, I'm going to be making some case very much building on what Mr. Tiwari said. I loved what you said, sir, so I'm going to be drawing on you as well. Another person I'm going to be drawing on is Mr. Sagar, who's hiding there, who spent several years and has been an architect for a lot of the things that were presented here. So, all right, so let me get started. Let me just give you 2 minutes on, recap of the second part of the paper, which is the main argument for privatization, why and how far. Implicitly, it's more laid out in the paper than in the presentation. The argument is really bad. Having a problem in the financial plumbing is bad for growth. It just any distortion in the credit origination system, especially in a growing country like India, has large welfare consequences through that. And that is a solid argument. Now, actually, the argument that you saw this morning or afternoon was not really so much that, but really what happened to the performance of public banks versus private banks. Now, exactly as Mrs. Tiwari said, let's go back to January 1st, 2014. At that date, about 70% of the lending in the Indian banking system was coming from public banks. Much of that was infrastructure lending. At this point, and this is where I want to bring in some political economy of it, there's a big political economy push, what was called the so-called 4R strategy of the government, which was to recognize, which is asset quality review, figure out what the problem is in the banking system and disclose it. That, no matter which country you're in, that's extremely hard to do politically, and they managed to do that. Second was to resolve, that's the debt resolution system, the IBC code, and other things that came along with that. The third was recapitalize, and the fourth was reform, and this strange term that you may have seen called PCA, which is prompt corrective action. So what that really means, so translating it from one part of my soul to the other, is what that really means is when you've identified a bank with serious problems as a supervisor, you can take supervisory action to make sure that the bank takes corrective action. So I see Anup here, who has a health background. It's like a patient, to make sure that the patient has high cholesterol, he's been acting poorly, and he's come to you, to your medical practice. You impose prompt corrective action to make sure that you have a healthy path again. So by the end of by maybe 2015, June or so, please correct me if I'm wrong, I think there were 12 banks under PCA. 11 of them were public sector banks and one private sector bank. By regulation, they were not allowed to grow. These banks were not allowed to grow their branches. By regulation, the employment. So in fact, it was a good thing because they were solving the sins of the past of this large infrastructure lending that was finally, with the great push, to overcome the political economy challenges, was revealed. So in a way, I don't think the strength of the argument for why privatize is to look at actually when the reform was happening in the sector, exactly as Mr. Tiwari said. But that does not take away from the argument for why. It's just that the sin was committed in the previous decade, not when they were repairing the system. So that's the first thing to say there. Now, there is indeed, and I wish you had quantified, I did this calculation a few years ago. I think the recap number, the fiscal injection that happened over the 4 or 5 years is about 6% of GDP for a given year's GDP, roughly, if I'm right, but put some brackets around that number, but that's a big number, right? So the amount of total recap, that's a very strong argument for why not to do, and that's just the cumulative burden that, is like the cholesterol builds up over years, and that's just crystallizing of that cost. So that's a big cost, and that's, I think, the big one. And also the other argument you all have made on the credit to GDP ratio, I won't put too much focus on the 47%. So, as a student of India from outside and not knowing much, so I'm speaking under your control, what I learned is it's very hard to tell the story of India no matter where you look. So in the financial sector, the story of India has to include the story of the non-bank sector. So I tried to do this very simple exercise, which took me months to do, is take together all the financial balance sheet data of NBFCs, housing finance companies, these small there's so many funny names for them. You put them all together, actually the total credit to GDP in India is about 75% of GDP, not 40, 50% of GDP. Still, the dynamics is exactly as you present. After 16, there's a marked change and there's a decline in the credit. So that's a problem, but just I'm saying, let's not focus too much on those. Okay. Now, the second part of the argument is how far, and here, as you've heard, all remaining 11 except State Bank of India, and then, the argument again is that it's the reason to protect state bank, not only because we have Mr. Tiwari here and to be nice to him, but the argument is that there is a social objective. This is something we cannot really, I try to remind myself as someone who does not understand India well, is there are social textures around the banking system that we cannot underappreciate. So I really appreciate, Mr. Tiwari, that you emphasize the role the public sector banks have played in deepening banking in India, in deepening access. It's very hard to get a bank to open up a branch in remote villages, and that's something that state banks have done. I think that's an important thing too. So we should be more open, perhaps these are tiny things around the margin. If I'm writing as a referee, just tiny comments to add rather than change the soul. The soul stays intact. I'm just putting different clothes or around the soul. Okay, so that's kind of the first part of the argument, and then how to do it. And this is beautiful, really. I think I try to write policy papers, and I think this paper has this beautiful element. This is exactly how I try to write policy papers, which is present the argument and give a very detailed prescription. So with the hope that one day as an economist, maybe nobody will read our paper, but when they do, if some open-minded policymakers reading it, we've provided all the answers. And I think this paper really does, and I really hope it becomes a key reference. So I'm not going to go over these arguments because you've seen it, because I want to show you some cool charts that I put together this morning. So I want to focus on two things, right? So typically, when we would, as an IMF economist or as an economist or a financial sector expert trying to study how to do reforms, thinking about privatization, you would want to put it into two broader contexts. Exactly as Mr. Tiwari said, what is the broader financial sector reform strategy? How does that fit into that? So that's issue one I want to talk about in the remaining few minutes. And the second, this is where my economist hat is, how does that fit into the growth strategy for the country? So these are two issues for discussion that I want to raise. Now, there is something which I call, at least to myself, to explain how the story of India to myself is there's a winner-take-all dynamics going on in the financial sector. All right, so to see that, please allow me to walk you through the liability structure of the banks in India. Okay, so on the on the other side of the screen, are private banks, and on this side of the screen, towards closest to me, are the public banks. The key thing I want you to focus on is this big blue bar. Okay, so these are basically your paychecks going into the banks. These are customer deposits, and the green bar are corporate deposits. So that's where NCAER or NCAER's deposits will be placed, basically. Okay. Now, if you look at private banks, the blue part, which is the sticky, that's the deposits that Mr. Tiwari wants to attract to his banks, because that's really a superpower as a banker, because you can always rely on that group. That's only 30% pre-COVID. I just picked the date, March 19. That's only 30% for private banks. So private banks are, some of them, and I'll show you who, are starved for sticky deposits, and they're pushing, they're playing, they're trying to get. The superpower of the public banks is this very large sticky deposits. So that's kind of the thing I want you to know is that, so you see the big difference there. That's the big difference, all right? Keep that in mind, please. Now, one way in which economists who study financial sectors, they look at this thing called the credit to deposit ratio. That is basically saying, how do you take those deposits that we saw on the previous slide and convert it into credit creation? Now, where's the gap from the credit to deposits coming? That's wholesale funding. Certificate of deposits, various forms of whole commercial paper. Now, all right, so there are many lines going on here. Let's look at the purple line, all right? The purple line is the arithmetic average of all private banks, whereas the gray is the 90-10 range of all the banks. What's happening is private banks are really high up on there, except a few very, very big ones, okay? Whereas public banks basically are much lower. The way I tell, in a simplistic undergraduate way, the way I try to tell the story to myself is the public banks have this huge, good superpower of liabilities that are sticky. The private banks and actually the NBFCs have this superpower of assets. They can go in and go into new areas that Mr. Tiwari was talking about, lending to used cars, things like that, which is traditionally not being done by the public bank. So in a way, that's kind of the tension that I want to bring out here. All right, now keep that in mind. And now let's talk about privatization. Let's put a little bit of color between the different children who are public banks and the different children who are private banks. I want to show you something why all private banks in India are not alike. So this is a very simple chart using equity prices. There's a lot going on here. So let's focus on the blue one, which is the top 4 private banks in India. And the starting point is after the ILFS default in 2018. So that's 100. Since then, the top 4 banks have grown in valuation just before COVID, just useful to end before COVID, by about 35%. The bottom and the yellow line or orange, depending on how you see it or define it in your culture, every country and cultures have different colors schemes. But anyway, the public are the public banks, the orange yellow, yeah. That has in valuation gone down, which is something that Dr. Gupta talked about as well, has gone down by about 20%. But look at the pink ones. These are the worst performing private banks. So they've done much worse. What has happened in this period, not just in the banking sector, but if you look at the Sensex more broadly, there is a winner-take-all, flight to safety type dynamic which is happening. And so not all of the private banks are alike. And so simply privatization, we cannot just change the label and imagine things will happen, but we need to do the hard work, which actually has Mr. Tiwari. I'm just aligning myself with you to give myself some cover here. So, okay. Now, a key consequence. So those of you who are students of monetary policy in India, as Mr. Sagar will tell you, know there's a big discussion has happened pre-COVID on monetary policy transmission breaking down. This is my version of my answer, a banking answer to that puzzle, which is very related to everything I've just shown you now. What has happened is once this prompt corrective action comes into place, right? So that's around 2017. You see the public bank recap is announced at the second vertical line here. Let me just stop for a second and tell you what you're seeing on the chart. So the y-axis is the difference in the term deposit rate and the repo rate by the RBI. So that's the spread, basically, that the banks are charging. So if repo rate is 1% and the bank is giving you 2%, so that on your term deposits, that will show up as 100 basis points here, 1%, okay? Now, the transmission puzzle was, why did this go up so much? Okay, so it went up it doubled, basically. Now, once this public bank recaps are announced, when the prompt corrective actions come into place, you see a divergence appear between the two children, the public banks and the private banks. There's a difference, right? And that difference is about 25, 50 basis points immediately after. And what is happened in India at this period, is there's a hidden run on the repo, just like there's a run on the repo in the global financial crisis in the US, which basically is shown here by the ILFS default and the Divan default. These are the two vertical lines on the other side of the chart. And this spread starts to go up. This is where, remember the first chart I showed you on the stickiness, the 30% versus not 30% sticky deposits? This is where it starts to bind. And this is where the competition for that sticky deposits goes up, which is what basically raises spreads. Now, why does this matter? Why does it relate to the paper that you've seen this morning? In a way, the fundamental broader reform that has to happen is how can we take, at least this is my version of the story, how can we take that stable deposit? That's a strength, that's an asset of it's a liability side, but it's a strength of the banking system. How can we take that stable deposits of the public sector banks, match it to the innovativeness, and I would say it's the socially good thing that a lot of the private sector banks and NBFCs are doing, which is going into the tier 2, tier 3 cities and going into SMEs and doing the lending 5 years. So that's, to me, a question. Now, you can just turn that question around. A corollary of that, or you can think about it as a warning. Actually, I'm just doing this opposite, but you can do it as a warning. If you just privatize And these, it's almost like national jewels. This is sticky deposits. You take that national jewels and you give it to the few top big banks in India, I think that would just potentially deepen. I'm putting it as a question. Couldn't it just deepen the winner-take-all dynamics? And what would that truly mean about the credit transformation needed to support growth? So, okay, that's kind of my issue number one for discussion. Very quickly, how that basically fits into my issue number two for discussion, which is, again, so I'm taking their paper, which is on privatization. I expand it into complementary tools by talking about broader financial sector reform, and now I'm going to expand it further to talk about the broader growth reforms, all right? So where will finance for growth come from? That's a question that I've been thinking about. This is using their measure. I'm just taking this credit to GDP ratio. I'm just showing deviation from the trend. There's a BIS measure, which is very similar to the RBI measure with some interesting differences. We can talk about it later. But the key point which they've emphasized is basically that this large decline relative to trend in the last few years. And as I've said, tried to argue at least, is much of that is actually self-induced to repair. So we should be more cognizant of that. Now, let me go a little bit deeper into this thing. All right, is this decline coming? Now, this is now more economics than finance. Is this decline in credit coming because of demand or supply? Right? It's very hard to answer these questions. We've had a lot of debates with colleagues here. And one way to look at it is translate that question to say, are firms that are otherwise healthy, that should have gotten credit, are they getting credit? All right? Now, this is also something Mr. Tiwari and Professor Panagariya talked about. A lot of the NPA, non-performing asset problem in India were the big ticket items, so the big, large firms. That's the blue line. So this is the large rise in NPAs. The interesting thing, and this is a developmentally important issue, is the non-performing the NPA ratio of MSMEs, that's the pink line, was basically flat throughout much of this period. So there was not much going on there. These group of firms, are by some account for half of exports coming from India. They're quite important employment-wise, maybe over 100, depending on how you count it. 110 million people they employ, so they're important. What happened was, before all these, the 4R strategy came into place and before the problems in the non-bank sector emerged, both the public banks and the NBFCs were doing a big part of the lending to the MSME sector. Okay, so here, it's too far for you, some of you, but basically the way to visualize that point is the green is the public banks and the NBFCs are the red. And if you see, as it gets closer to 18 and 19, both of them basically shrink to zero. So that's where the credit is withdrawn because basically these prompt corrective actions come into place and the NBFCs come into place. That's where, someone made a reference to the Agarwals doing businesses. That's where my cousins were complaining because they were not getting credit. Basically, my Agarwal cousins who were the MSME owners, or my dad. Okay, so then basically, there are various ways to document this. Basically, I've tried to figure as many ways as I could to show that really the supply of credit is what retrenched. I don't want to spend more time on that. Now, going to my macroeconomic hat and just show this period was one of the slowest growth period in India. This 2000, growth fell to about 4.1%. If you look at where the growth declined, it was exactly the credit-sensitive sectors. No point going too much into detail given the time I've left, but basically you can see it's manufacturing and construction sector. I'll share the slides with you afterwards. I'm not going to focus on this. This is my way to tell myself the story of where the clogging in the financial system is. But let me just go to my last slide, issue for discussion. So this is another thing I've tried to do is put together a district level GDP measure of India. I could only do this for 1 year. But, there are huge gaps in income across India. There are, there are 2 states in the north, which is basically Uttar Pradesh and Bihar, which are where the reds are concentrated. 1 out of 4 people in India live in those 2 states. Take Bihar, the population is 120 million people. The largest city, Patna, has about 2.5 million people. Prachi is from there, so she knows. She told me this account, no? now bigger. Okay. If you go to the district level, it's 5 million. At the metropolitan area, is 2.5 million. So, but anyway, so the point is, in a city, to me, a fundamental question from growth is, who is going to finance the credit into these cities where much of the Indians are living? Who is going to finance the education loans, the car loans, the motorbike loans, the farmer loans, the tractor loans? And in a way, how can we ensure, and this is my request to Dr. Gupta and Professor Panagariya, is how can we put in that textural element to broaden the complementary tools that, and maybe this is where the political economy constraints get real. So let me stop there, and thank you for your attention. It's not super organized because I prepared this morning, but I hope it helps set the stage for discussion. Yeah.
Thanks, Richard. I don't know what you would have done if we had given you more time. So this morning. Okay, so let me just get a sense of the room. How many questions are there? Otherwise, I'd love for them to respond first and then have your questions, but let me just get a sense of how many questions are there. There are 4. Okay. Prachi first, and then, I'm sorry, ma'am, I don't know your name.
Can you respond quickly? Or
You want to do it before? Huh? Let's just you'll get a sense of how hostile the crowd is.
That was pretty hostile in itself. I need a break.
Yeah, Prachi, please, just if you can keep.
Thank you very much, Poonam and Professor Panagariya. This has been an excellent discussion. I'll just, a couple of things, first on the data and how the case could be strengthened, and then a few questions for you on policy. I think Ruchir pointed out, I think it will be good to give a more wholesome picture of non-bank sources of finance and how that has happened given NBFCs, but even how what has been the trend in outside bank sources of financing, just to give an overall picture. Second, I think Mr. Tiwari noted this, when you talk about private banks, you kind of club together the old private banks and the new private banks. I think the statistics you presented, if I'm not mistaken, are more from, I don't know, either you club them both together, because old private banks, Mr. Tiwari pointed out, Lakshmi Vilas Bank, South Indian Bank, Mercantile Bank, whole number of these were not nationalized in the waves of nationalization in 1969 and 1980, and these were deemed to be too small, and they exactly look like state-owned banks and not like SBI, other state-owned banks. So I think that there has to be clarity on that. Third, I thought credit. When you talk about credit, I think credit is a very heterogeneous. If you break up credit to whom, and for example, credit to personal loans, etc., have exploded. It would have been good to see how that is varies by type of banks: old private, new private, public sector, SBI, others. So these were a couple of things on the data part. I think on policy, I think a couple of questions more for my understanding and maybe off. As Mr. Tiwari mentioned, it's already been announced privatization of 2 public sector banks, and what is the progress on that? What happened, and whether they've been probably they've not even been floated, or they've not even why hasn't that happened so far? I think a little bit more flavor on that. Second and third, more Is there a case for going slower in terms of thinking about more allowing strategic investors in terms of financial institutions which are more well regulated, listed institutions, allowing them 5 to 20% minority stakeholding, but large enough so that there's some incentive for actual governance and engagement and market discipline without full-blown privatization? Is there a case to be made for that? And third is, is the alternative approach to allow, more bank licenses? It's known that given the size of the country, there's not enough. The banking sector is still pretty concentrated, and allowing more competition. And the truth is that the share of public sector banks has declined over time. So why not allow a more organic way of their share reducing in the market, rather than thinking about full-blown privatization, which is politically hard, we've seen for so long. Let me stop here.
Yes, sir, you, and then ma'am after you, just in the same row.
I am Ram Singh from Delhi School of Economics. I have 2 questions to the authors of this very interesting paper. First question is within public sectors, SBI and other banks are subject to same regulatory governance structure. Yet their performance is very different. One, SBI has performance comparable to best of private sector banks, but not the others. So it can't be the governance or regulatory structure that can explain all the difference. Is it something related to the size of the bank? Does size of bank matter more for a public sector bank compared to, say, private sector banks? The other question is, the public sector banks, other than SBI, had disproportionate exposure to infrastructure sector, but also they were victim of, for them, big size defaults come quote unquote scams. So if you take away these, if you treat them as one-off incidents, do they still come across as inferior on performance standards compared to private sector banks? That's all.
Yes, ma'am.
Rohini Somanathan from the Delhi School of Economics. I had one question for Mr. Tiwari and one for the authors. Thank you all. It was very, very informative. Mr. Tiwari, I've worked a lot on self-help groups in Jharkhand, particularly in northern Orissa. And because you joined in 91, I was really very keen to ask you, there was this RBI circular in 91, which is what really started off the SHG movement in India. And I've been looking at it just from the household side. And this completely transformed the rural landscape in many of these areas. You had these NGOs that went and got these women together. And basically that circular said that if a group of women come to you, and they don't look as if they're going to do anything terrible, they don't have to have much ID, they don't have to have anything really, just open an account for them. And that was pretty much what was happening. So there was very little oversight, very little regulation. And looking at this in very poor parts of Jharkhand, it was just transformative. And so there were people who said, we wouldn't put mud on the stove because we would be too depressed. And we have a meeting, an SAG meeting in the village, and now, we're going to wear a nice sari, the one that we have, and so on. So it completely changed lives. But the deposits were tiny. I mean, each of them were contributing 5 rupees at that time a week. And so the cost of maintaining that was pretty high. Now, my impression was that the default rates were very low compared to other priority sector lending, such as agriculture, at the time. So I just wanted, from a banker's perspective, to actually, who saw this whole transition, this movement start, I just wanted to know whether you thought of it as a success from the financial perspective, or whether these were just my impressions from the ground.
Do you want to respond to 3 of them, or because that's 4 more questions?
I just had a small question for Poonam and Poonam and Arvind, which was that when you're talking about the transition in which banks should be privatized first, I just wondered whether you thought about the spatial distribution, because when these banks developed, there was this lead bank scheme. So a lot of the rural lending in particular states were done by one particular bank. So if you change and say we'll privatize this bank, what implications does that have for rural lending in that particular state? And what should come in to replace that lending? So that was the question.
4 more questions. You want to respond?
Yeah, I'll respond.
Don't respond to both of them. Respond to those.
That's easy.
So actually, I will just combine them all. If
Okay.
It's okay. So very quickly, forgot to mention that our earlier discussant was Krishnamurthy Subramanian, the ex-CA. He fell sick, so he could not come. And Ruchir very graciously stepped in last minute. But I wanted to be cheeky and say that it's evident that he didn't have enough time to prepare his comments.
I would have been more generous. Right?
And I thought we were picking some nice, benign discussions, which we were not. But jokes apart, I think there are 3 or 4 main objections or cautions that our discussants had. One was a very benign explanation for the poorer performance of the public sector banks, that they invested too much in infrastructure. So 2 counters to that. Why did they do that? Was there some political pressure, or was it just poor risk assessment? In either case, ownership is correlated to both of those. So that's one explanation. The other is actually, as I said, my own thinking evolved as I went along during this research process. Professor Panagariya was clearer in his approach and what he wanted to say. So actually, until I saw first the allocation across sectors of credit, and then within sector NPL for public and private sector banks, right? So the way the data is presented at a very broad level, the credit is to agriculture, personal loans, industry, and the rest, which is services. And the NPL ratio is different for all of them. The NPL ratio currently is the highest in agriculture and in industry. And within sector, NPL ratio is much higher for public sector banks. So the story is not of a different sectoral allocation. No matter how they're allocating, they are incurring higher NPLs within agriculture, within retail credit, within services. So that takes away this assumption that had they not invested so much in the infrastructure, everything would have been fine. Their sectoral allocation actually are converging as well of public and private sector banks. Agriculture is steady because of the priority sector lending norms, and both kind of banks are moving away from industry, it being a very high NPL sector, towards retail and towards services. So that shift is happening, but despite that shift, public sector banks are incurring higher NPLs. Another point that was being made was that this entire problem is actually concentrated in the second half of the last decade, when PC, etc. started. And that's exactly what we show in our data when we have 5-year data broken by 5-year period, right? So even in the first half of the decade, public sector banks were performing very poorly across 7 dimensions that we saw. It's just that it worsened. Now the question is, it didn't worsen in the second half, but it was brought to light, right? But the problems had started much before that. So it's not that the problems started because of the PCA, problems were already there, and they came to the fore when they were pushed to bring them out. Another is, in some of the charts, fancy charts that were presented by Ruchir, 2 things, very selective time periods, right? We all do that to make a point quickly. But my reading was that public sector banks have had an undue advantage, if anything, right? So they are the ones where most of the public government's business is going. So that is what my reading was, that private banks, despite relying on more expensive sources of funding, are doing better. And therein lies actually a partial response to one of the questions that Ram asked on why is it that the SBI is doing so much better. Scale economies, there's no other bank which is as large, certainly, but also an undue advantage, right? So most of the government business is with them. It's another story that Air India still could not do well despite getting all of the government's business, but SBI is somehow able to leverage that business. Just one very last point before I come to some of the questions. Professor Panagariya can handle them much better than I can do. Ruchir equity market, again, you're showing a very selective small period of 2.5 years monthly data, 10 years, right? Just look at the divergence that has emerged. When you break it into 2.5 years, go monthly, you may get another story, but 10 years of data does not lie. Now, on some of the questions that were asked by the audience, let me see which ones can I handle. SBI I have partially answered. Prachi's question on sectoral credit I have answered. Non-bank sources of credit absolutely are taking the space up, and that's how we are still getting 7% growth. This is shown in another paper that I did on the growth slowdown during 2019-20. And we show that one of the 2 main factors behind that slowdown was the NBFC crisis. So banks were already slow, NBFC had a crisis, but other sources of financing picked up the space quite a bit. Private equity, private placement of debt, markets, etc. To progress on 2 banks, we are not privy to anything particular, but whatever we are hearing in the corridors is that there is political commitment, but at the same time, they're aware of the challenges that lie ahead, right? So after the reversal of the reforms, I think the government is just testing the waters, but there is commitment to do that. And we keep hearing with every session of the parliament that perhaps it's about to come, and it doesn't. So opening up the sector, absolutely. I mean, this is something that's needed, but just imagine what will happen to the public sector bank. And the cost of inaction is you bring in more private banks, and this segment will just wither away, right? And the problem is that it's not costless for it to wither away. There is cost of inefficiency, which is being borne literally by all stakeholders in the economy, but a very high cost is also the fiscal resources. You know, this very first session that we had today was telling that there's very little money being spent on R&D. So do we really want to keep this body alive by putting money over and over again? And government being the largest stakeholder will have to keep on recapitalizing the banks. So, you know, among other things, so there are two kinds of cost, and here I'm just playing up the fiscal cost among others. Others may be somewhat harder to quantify. So I think I'll stop here. All yours, Professor Panagariya.
Right, thank you, Poonam. I think you took up most of the difficult questions, so I'll take the easier ones. By the way, we didn't have you earlier because we discovered you only yesterday that this brilliant man has to come on the stage to speak. So, you know, if we had known earlier 2 months ago, we would have still come to you. So
Maybe I would have been a co-author with you.
absolutely. Oh, if you still want to be, we are very happy to have you.
I want to keep my day job.
We are absolutely very happy to have you. Okay, on some of the things, I think most of it has been covered by Poonam. No, employment and branches expansion, I think I agree with Mr. Tiwari, very true that actually that was a good thing that the employment was held back, branches were even allowed to close down and all. That's a good thing, because if excess branches existed, then we, or excess employment existed, it's good to let it decline. The point of our slide only was that there is often this thing that private sector doesn't create jobs, whereas public sector does. And I think that slide shows that private sector, in fact, does create jobs when it expands. And branches, it also opens branches. There's also widespread impression, by the way, that it's only public sector banks which open the rural branches. That too is not true. The private sector, you know, SDFC, etc., are going deep into rural areas. In fact, sometimes even in areas where public sector banks are not going, they are going there. So that's a clarification. Mr. Tiwari also raised that issue of the bank. This was the Yes Bank, which had to be bailed out. And obviously, State Bank of India took the bulk of the burden of it and is still bearing it. Right? My response on that one is that why should you have to do it this way? If there were no public sector banks, then the government will have to do it in a far more transparent manner, either put up the taxpayer money so that everybody can see it, or find alternative ways to let go of the bank while protecting the interests of the depositors. So, you know, the very fact that somehow the private sector bank, when it's going under, has to be saved by, you know, using the basically capital of the public sector banks, I think it's a very bad way to help the bank. Given the circumstances, I think that was probably the only way, and it was done, but it should be done in a more transparent way, and this will not happen as long as the public sector banks in these very large numbers are there. I think that is the easy route for the government to choose. On the question of who will finance the poor in Bihar and Uttar Pradesh, Ruchir, it is very clear that the public sector banks are not the answer there, although rhetorically you seem to suggest that that is the answer there, because the very fact that these poor have not been financed means, and public sector banks have been there, means that the public sector banks are not doing it. So there is a different problem to be solved. So that rhetorical question doesn't actually, from me at least, invite the answer the public sector banks will do it. They haven't done it. right? On the rest of it, why SBI is doing better? One of the key, I think, this is to be examined, but my explanation is that among all the public sector banks, the State Bank of India has much better quality staff. That does make a huge difference. So that's a compliment to Mr. Tiwari to get him on our side, but actually I've spoken to others as well on this issue, and that certainly is one of the factors. Size may matter, but the point is that, after all these other public sector banks have been in business for very, very long also. So how come they didn't become larger? They should also, if State Bank of India could become larger, maybe even when they started, State Bank was a little larger. I'm pretty sure it was the case. But they've had this time, they had 50 years. They should have become larger. So I somehow think that State Bank of India has been very successful in getting generally good staff. On the spatial distribution question that Rohini asked, there's a presumption, it seems to me, there that somehow once privatized, those banks are not going to serve the population. Well, after all, if the branches are there, branches will continue to serve that population. So I don't see that is a major issue. In fact, they might start serving them better. The last point about the infrastructure, right? That it is true that the public sector banks, by the nature of the political economy in India, were asked more to finance these give these infrastructure loans. But again, that begs the question, why should that be the case? Because the public sector banks are there, they get used to promote all kinds of objectives, whether sensible objectives or not, whether they are the right instruments for doing it or not, but just because they are there, let's give it to them. That's also a bad way to do things. Let them be all on the same plane, and then the government, see, a lot of the improvements in the policies of the government will also not happen if the government finds an easy way that, here are public sector banks and let me use them to do it. So I think there is a deeper reason actually why which perhaps we didn't articulate, which is a lot of the reform needs to happen. A lot of reform needs to happen, but that cannot happen unless the bulk of the public sector banks get privatized.
This is how, could I respond for 30 seconds?
Sure. There's just 4 questions we'll take because those 4 hands were up before, but you both just quickly respond. You can respond to Rohini, and you can respond to
I just
that.
want to say 2 very quick things. Actually, to be very clear, I am definitely team Gupta and Panagariya. I am trying to make your prosecution's
he's
case.
printing an SBI book.
No, I just want to be. I'm not Team Tiwari. I just want to be clear. My goal was to make your prosecution case much stronger. And point 1 is, I think exactly the argument you laid out at the end and the fiscal argument is sufficient. The looking at the employment, etc., is just a symptom of actually the repair. It just does not. To the insiders who know the institutional details, it reduces the credibility of the argument. So I'm saying focus on the original sin, not the repair that the doctor ordered. It is first point. Second, I think your challenge to me on who will finance the rural India or tier 2, tier 3 cities is a very good one. I really don't want this subtlety to be lost in the subtlety. So let me try to be clear. I do think the NBFC sector and some of the housing finance sector have played a very important role in doing innovative lending. And to me, the highest growth cost is this liability structure. The savings of households get channeled to the biggest banks, private banks here, who already have easy access to funding, and we don't truly finance the place where they have highest growth multipliers. So that's why I want to ask you to embed your strategy in the broader strategy of where the credit transformation will happen. Thank you.
If you could respond to Rohini, then I'll get the 4 questions and we can wrap up.
Yeah, so I didn't think, Ruchir, you should have waited for lunch at least to switch sides, but anyway, it doesn't matter. Coming to your question, actually, the self-help group, that circular which you talk about, and subsequent regulations which came in, it is true that the thinking then, oh, sorry, I thought it was working. Can you switch it on?
Doesn't matter, just use this.
Oh, thank you. Sorry. So I agree the thinking then with the Reserve Bank and other agencies which were involved was to keep it as simple as possible because it is so low ticket. The limit was 2 lakh rupees for a very long time. This is till 2000s. So and the general size was 25,000 to begin with, and they were called under, after some time they were under this so-called Swarn Jayanti, Swarojgar Yojana, etc., etc. Now, I was in a rural branch in the early 1999 to 2002 in a district of Unnao, which is core UP and way beyond the main center of Unnao, so therefore it's a core rural. And I myself done the self-help group grading, etc. There were grading to be done for before releasing the first element of subsidy and then the second element of subsidy, and the account should have run. So there were some simple regulations which are put in. The good thing was that was kept very, very simple. Initially, actually, the banks were they asked to only take the KYC of only the 2 secretary and the president of the group, not everybody. Now today, unfortunately, because of the KYC AML regulations, all the 20 have to give their documents. Now, of course, we have the documents, we have Aadhaar and all. But for some time before the Aadhaar came in, we had this massive problem of how do we get KYC of everybody. Many of them did not have good documentation, and this created a problem. But over the years, as I personally saw and as I saw through the bank as well, this has been a fantastic experiment actually. And your observation of their default rates being low is right. Some groups, of course, which were formed only for the purpose of taking subsidies, they went bad, but those were bad in ab initio. But those which had come up organically, either through NGOs, because they had to be curated by NGOs, they did not have their, most of these women were not educated and they didn't have the either the skills or any managerial bandwidth at all. But what I have seen actually ultimately, and we at State Bank of India, we also run about 14 regional rural banks. So those are even beyond, I mean, they are restricted to each state, each of them, but they are in the real rural and semi-urban areas. And there the biggest segment of credit is self-help groups, almost 30-40%, and they are the ones with 1 to 2% of NPLs. So I think this is a fantastic story. People have to talk about it more. We all talk about the Grameen experience, but this is our homegrown experience. We need to do much more in this area and talk about it much more. Thank you.
So, just for Devesh, gentleman there, Mridul, and this gentleman here, you had your, so if you could all 4 just ask your questions and then everybody can respond.
Yeah, so on the issue of who should be allowed to buy the banks, especially non-financial industrial groups, suppose the only sort of bidders are Adani and Ambani. What would you say? Do you think would you be sort of anxious, or you think it should happen? And one question for Mr. Tiwari. The largest debtor by far is the Adani Group. By far, its largest creditor is the State Bank of India. Should that give us confidence in the State Bank of India?
Dilip Mukherjee. So hearing the arguments sort of broadly on one hand, the superior operational efficiency of the private banks, on the other hand, the social objectives which may be better served by the public sector banks. We also hear about the heterogeneity both within the public sector banks as well as within the private sector banks. So that gives rise to the possibility of an intermediate option, which is just consolidate the public sector banking assets into the State Bank of India, which seems to be more efficient than the rest. If there are economies of scale in banking, then presumably, and you want to avoid undue concentration of capital in the private sector, it creates problems for regulation and so on, that is an intermediate option. So could that be on the table between the 2 extremes?
Yes, sir.
Thank you. I want to make one comment which is sparked by what Devesh just said. if I may make that comment. I think your work and your paper is coming at a very important time. Because I think it's quite clear India and the government of India is preparing how to transform our banking system and shift away from public banking. So I think what you say and what you do is going to be critical for the shape the reform takes. Now, my only comment is this. Looking back at international experience and looking back at India's experience and looking at where we should go, I would hope, and I would propose, and I'm sure you are going to do this, is take a clear position on the conflicts of interest that may have been a problem in the past, as we've seen in other international experiences, not just crises, but financial situations, conflicts of interests in the policy framework and policy implementation have been a major factor. The issue is much broader than just public banks, private banks. So my only point is, I hope you will go through the conflicts of interests that there may have been in India, and if so, how are they going to be removed? Because once you identify a policy problem or policy conflict, how are you going to remove it? And then as you look at the future financial system, what are we doing to make sure that policy conflicts do not come back in a different form? This is much broader than the issue of corporates owning banks. But I'm just saying conflicts of interest are so important an issue that if you broaden the scope, it also includes the role of the regulator. I would hope, I would propose you look at that too, because the role of the regulator is very important, as we've seen from countries, a growing number of countries, in Indonesia, Korea, Japan, Australia, and numbers are going up. Central banks are being divided into a central bank and a financial supervision authority. Should India go down that route, like has been done, as I said, by Indonesia, Korea, Japan, Australia? So I'm saying there are broader issues of policy conflict which affects our banking system over the next 50 years. And what you're doing is not for the next 3 years, but the next 50 years. So I would hope you would go into these kinds of issues too.
Mridul, besides the obvious problem of RBI not being in the paper.
Okay. Now, first let me compliment the authors. I mean, the paper is exactly what a public policy paper should be, because that's what we see. It has thrown a range of issues across the chairs here. And what I like about the paper is that it doesn't beat around the bush. It straight away says what it is the solution and go radical in that. But having said that, my thoughts are more with Professor Ram Singh there, that was a question I had in mind also. He raised the issue that basically, is it the size? I think the size and the scale and scope economies may be one of the reasons why SBI stands out. So, I mean, if one thinks what is so unique about SBI that is closer to private sector bank, I think it's very clear that the government interventions are more severe in case of SBI than it is in case of probably other public sector banks. I mean, they have a huge onus put, whether it is on infrastructure, whether it is on priority sector lending, the food credit, for instance, that whole consortium is largely managed by the SBI, which is unable to invoke the government guarantees because government is the owner. And therefore, it's important to think through that why a single PSB is the best solution and not the consolidation of a few PSBs, because in essence, what we have is if scale and scope economies are driving, a better solution might be to retain a more competitive structure
I know exactly the private sector banks can offer competition. I mean, that's also a fair point. But in the sense that basically the public sector banks, if a few are there and can be consolidated, can offer an alternative optimal model for the financial sector reforms. So this is something an extension of paper could probably establish. I'm not saying this necessarily would come as a result, but at least it's worth showing that the single PSB is better off than the others. Now, the other part of comment from Professor Ram Singh is what I don't exactly agree, that it is not to do with the governance. I think the governance still is the key to the future of the banking, especially the public sector banks. And if one was to say where, I mean, number of solutions which this paper suggests, if the government would have heeded the PJ Nayak Committee report of 2014, these questions would not have lingered with us. I think we didn't take into account with seriousness, because PJ Nayak Committee report had clearly argued for repealing of Nationalization Act, the SBI Act, the SBI Associates Act, so basically bringing down the ownership below 50%. I think the government, it was clearly that the shares were to be transferred to basically a banking investment company, which never happened, and a low-key reform in the form of Bank Board Bureau was what was put forth as a solution. And now, to be honest with you, the Bank Board Bureaus did not work. I mean, the interference from the Department of Financial Statistics Services was rampant in the sense it was never conceived. It was conceived to be a modern sort of headhunter solution, which was never really implemented. And today we have landed in a situation where the Financial Services Institution Board is replacing the Bank Board Bureau, essentially out of a legal judgment of the High Court, not necessarily depicting the essence of what the reforms should be undertaken. Now,
if you have just a few more, because I want all of them to
okay,
respond.
sure. So let me wind up by just pointing out that basically in terms of the powers, you know, I mean, the regulatory power which actually was raised by Ram Gopal, that the regulators are very important. I think the issue is not whether you have a single regulator or multiple regulator. People who have gone on multiple regulators have switched back to single regulators also, as in UK. So it really is the issue of whether the regulation has the power to deal with it or not. And I can quote half a dozen legislation changes that are required, basically in Banking Regulation Act, in order to empower the regulator to regulate the public sector banks, which are not really existing. I mean, you can't really trigger a liquidation of the bank, you can't force a merger, you can't dismiss a board, the supersession of the board is a very essential power which regulators should have. I mean, so there are a range of such things which come in way of actually regulations, and that's something which needs to be taken care of.
Poonam, then let me go.
Okay, sure.
Okay.
So yeah, Devesh's question. State your criteria for qualification of who can have the bank, who can be given a banking license. You know, this is like when for procurement there is a technical qualification that is done, and then you do the whatever, and then you do the actual auction. Do the same thing. And if in the end, based on those criteria, hopefully sensible ones, if Ambani and Adani are the only two that qualify, that's fine with me. I am quite okay with that. Or if they completely disqualify both Ambani and Adani, I am fine with that too. So lay down your criteria, qualifications, and then give them the entry. Dilip's suggestion is interesting and intriguing when I think about it. Maybe there is, even within that midway solution, there is something more midway also that maybe takes some of the public sector banks, not all of them, and merge them into SBI. That's another possibility, and privatize some of the remaining ones. So that's another one, but I want to think about that. So certainly it's something that at least I had not thought about. There are issues here, whether you could actually make SBI worse because of because it has to take over some of the really bad banks and so forth. So there are other issues, but that's an alternative I'd not thought about. So I'd like to think about it. Anoop's conflict of interest, etc. That's it. This is a focus paper on some specific sets of issues. Is one conflict of interest, which of course comes from the ownership by the government of the banks, which led to all the crony lending that happened 2008 onwards, or even earlier actually. That conflict, I think, will remain as long as the banks remain in the. It is purely a matter of which kind of government comes into power. There are some governments which will not. This government generally has kept its hands off, in terms of making telephone calls to the banks that give money to this, give money to that. But tomorrow there will be a different government. So unless fundamental problem will not go away, the commercial pressure has to be there, and so that's the way you have to go. I think Mradul answered his own question. You answered your own question. You pointed out all these good things that can be done, but they have not been done, and that is our point. That as long that with keeping the ownership within the public sector of these banks would not would not result by the government of the necessary reforms. NAEC committee, you're saying if the NAEC committee report had been implemented, that is the whole point, that it will not be implemented given the bureaucratic structure that exists today. I have also worked in the government for 3 years now, and I have a reasonable understanding of how the government functions. Likewise, you mentioned regulation. Of course, you can change the BRI, but that will never happen. If the government owns these banks, it is going to be the master of those banks. If it was willing to actually relinquish that control, then of course BRI would have been, or BRA would have been reformed, but it's not going to happen. And that's precisely the reason, and it's a good thing actually, because there is some momentum now towards privatization, so let's capitalize on that momentum.
You want to respond to why you're lending so much?
So it's not only Adani where we are the largest, we are also largest in Ambani, and also largest in Tatas and Birlas, and except for maybe some groups, we are largest everywhere, simply because we are the largest in the system. To the checks and balances, the regulator has put a lot of checks and balances. One is the large exposure framework, where we are not allowed to lend beyond a particular level of our capital and reserves. Gradually the idea is to bring all the larger groups and larger exposures towards non-bank finance, which is bonds and equity, etc., etc. So this is a work in progress, because for many of the larger groups, if all the banks are prohibited to lend, then there will be a challenge from the market absorption point of view also. However, having said that, the entire exposure, our lending book is upwards of 25 lakh crores or 25 trillion. And to any of these groups you talk about, it's not even 1 lakh crores. So I think we are fairly secure there. We don't see a challenge. And some of those companies from these groups are world leaders. So we have to acknowledge that as well, despite all the other controversial things which are talked about. So we do this as a commercial lending on its own merit, not because this is one name or the other name. So that's where I would like to respond. Thank you.
Would you mind the 10 nationalized banks being merged into you?
Personally speaking, again, I don't speak for the bank or for the government in this case. Personally speaking, I think this will create a much, much larger entity. I think it would be a huge concentration risk. As it is, 25% is a large enough number. My suggestion would be, if at all we were to consider this kind of an approach, I think the next 2-3 larger banks could perhaps be combined and reach a market share of, let's say, 15%, which would be a fairly large number. But that would be a good counterpoint to as a public sector bank, and together 25 plus 15 will be around 40%. So that would be a good number to have. That could be an intermediate solution we talk about. Of course, a lot of reforms, etc., which have been talked about, and Mr. Mudul talked about, and Dr. Panagariya has been saying. So they could be done. PJ-NAC committee again is something which is gold standard. It should be done. My own view, personal view again, is the fact that in 2014 this report came out, and the only implementation, as rightly pointed out, is the Banks Board Bureau. But this period from 2015 till 2019-20 was a really traumatic period for banking, for public sector banks, especially because of the NPA overhang and various other issues. And therefore the government's entire focus was how do we get this right? And there were all the issues, all the steps which were taken were focused to that rather than to the structural reforms, which, as Dr. Panagariya rightly points out, if they are implemented, I think public institutions can do as well as any. I mean, NTPC, for example, in power sector is doing as well as any other power sector plant. The performance, various benchmarks, if you look at it. So why can't all the public sector banks also be the NTPCs, or rather than the BSNLs of the world? I think we can have those kind of models as well. Thank you.
Let me just take 30 seconds to say, first, exactly as Mr. Tiwari said, now I'm Team Tiwari here, I would really be worried about too big to fail and too political to fail to make the SBI bigger. So that's just and I agree with Dr. Sagar on the need for much more intrusive powers for supervisors. This is key. How it's done operationally, Dr. Singh, I think is secondary compared to having the intrusive powers. And lastly, if I may just say, I just love the discussion that we've had, and thank you for writing that paper to start that. But I really hope that there is a community of scholars, thinkers, policymakers working on macro financial issues in India, because the welfare importance of this issue is so much more than many of the other issues that currently are the focus of at least academic economists. So if we can do more of this, I would really, it'd be God's work. So thank you.
Just very quickly on this intriguing issue that Professor Mukherjee raised, consolidating rest of the public sector banks, on which Mr. Tiwari has already spoken, echo that sentiment. SBI is already too big to fail, in the sense that, if you may recall, during 2009-10, some of the private banks actually faced deposit withdrawals, and all those depositors went to the SBI because SBI is considered to have the strongest of implicit deposit guarantee. So think about making that bank nearly 60% of your entire banking sector, and what can it do to destabilize everybody else in the market. Instead, we were told by Ruchir that there is heterogeneity within private banks. 4 of the top private banks are doing very well. Why don't we allow them to become larger? Which is about whether you call it privatization or whether you call it merge your poor performing public sector banks with some of the best performing private banks, so that they also become about 8, 10, 12% of the total banking sector. I think that's the approach I would